Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On this episode, we've got one of the country's biggest investors, Garey Aitken of Parkland, Templeton, where he runs about $8 billion in money, and he deploys that all in Canadian stocks. And in fact, so far in 2025, Canadian stocks are outperforming U.S. stocks. We talk about why that is and where he's finding opportunities in the market. And remember, if you want these pro picks directly to your inbox, make sure you go to our website, inthemoneypod.com, and hit that subscribe button, and you will get them twice a week. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. If you're looking to build a portfolio based on in-depth analysis and long-term strategy, you understand the power of informed decisions. With BMO InvestorLine, you get access to a wealth of research, market insights, and educational resources, including the BMO Investment Learning Center. Open a new BMO InvestorLine account and you could receive up to $3,500 cash back. It's a great way to jumpstart your investment plan. Learn more at bmo.com/online investing. Garey Aitken of Parkland Templeton, thanks so much for joining me.
Thanks for having me.
So you run a pretty massive portfolio of Canadian stocks, and Canadian stocks right now, it seems, are benefiting from a sell America trade, notwithstanding, the moments where we start to think, okay, maybe it's not going to be a crisis with respect to trade relationships in the United States. Generally, this has not been a great year for U.S. stocks, and global stocks have done better. To what extent has Canada participated in that?
Yeah, Amber, Canada has participated in that as well. I think we could go all the way back to the November election, where Trump scored a victory, where perhaps we've seen some erosion in that notion of U.S. exceptionalism. So make no mistake, the Canadian equity markets had a rocky few weeks, as well as it have some other markets throughout the world, but they have fared considerably better than the U.S. equity market during that period. And then that's also with a backdrop of generally a weaker U.S. dollar vis-a-vis the Canadian dollar, the euro, the Japanese yen, Swiss franc, etc. So definitely some interesting times, and that's really unusual. Typically when we see bouts of volatility or uncertainty, there's a flock to safety. You see U.S. dollar strength, and often the U.S. equity market outperforming other regions. So it's been a different story so far this year and in the recent months.
So the big question, of course, is this just a flash in the pan where the U.S. is experiencing a hiccup, or is this the beginning of longer term sustained outperformance by Canadian and global markets? How do you think about that question?
Well, I think it's still too early to tell, Amber. Certainly as a Canadian-centric manager, I would love to see Canada get its mojo back relative to the U.S. I mean, really, we go all the way back to the time period after the great financial crisis. Really, the U.S. started outperforming Canada 14 or 15 years ago. So I think it's still too early to tell. I don't think that notion of U.S. exceptionalism is over per se, but I think some damage has been done. And I don't know if we're going to get back to, even the perception of the U.S. dollar and the U.S. equity market anytime soon. I do think that the policies coming out of the White House, have been very disruptive. But at the same time, I don't think that we're necessarily, it's a foregone conclusion that the U.S. dollar in any way loses its status as the reserve currency of the world, or we're in for really marked weakness with respect to U.S. equities. I really think it's too early to be thinking along those lines, Amber.
So let me put a scenario in front of you where Trump sort of walks back most of the threats. And we've seen an example of that this week where, we went from severity on China to just kidding, we're going to play nice with them. Does that automatically mean we go back to U.S. exceptionalism? Because we see how desperate the market is for anything along these lines, right? You get huge kind of rip your face off rallies when we're starting to get sentiment in that direction. But it sounds like, if I'm listening to you carefully, that you think there's going to be a lingering effect, almost a hangover of going down this road in the first place.
Yeah, I don't think we can uncook this egg now, Amber. You're right. So if we go back effectively 3 weeks now to April the 2nd was Liberation Day, and we know what happened with equities in subsequent days. Then if we fast forward to April the 9th, and I think that there was a lot of concern even in fixed income markets with respect to volatility and the disruption that these policies had caused. We saw the White House walk back some of their threats and defer some of those retaliatory tariffs. And then things started to deteriorate. And to your point, in the last 24 to 48 hours, we've seen Trump ease off on his pressure with respect to Powell and potentially removing the Fed chair. And then also, maybe alluding to a bit of an off-ramp in terms of striking a trade deal with China. So I do think that the White House is balancing things off. They've got a view, but certainly they've got an eye on markets too. So then I think, Amber, it raises the notion of, again, that Trump put, meaning, if things were really to deteriorate, ultimately, can the markets be saved by actions or words by Trump to ameliorate concerns?
Yeah, it's almost like the markets are looking for Trump to solve the problem that kind of he created in the first place.
That's right.
With going down this tariff path. Let's take a moment for Canadian equities, because I want to, it's outperformed the U.S., but we're still down on the year.
Yeah.
We haven't done as well as Europe. Gold stocks have been the primary reason that the Canadian markets have held up, and there's a lot of pain to go around. But under the surface, people look at things like valuation and dividend yield, and it's a cheaper market, and you can get higher dividends here. How does that factor into the edge that maybe Canadian stocks have right now?
No, that's a great point, Amber. So that's a message that we convey to the marketplace, is that, again, going back over 14 or 15 years, we've seen market outperformance of the U.S. relative to Canada. And I think that some of that's certainly justified if you look at the complexion of the U.S. market. There's some terrific businesses there. The quality of the growth, it's really been exceptional. But at the same time, we've seen a real big re-rate, or that's a fancy way of saying higher valuations in the U.S. So I think even when we normalize some of the differences between the markets, and we see that Canada's got more of a resource orientation, there's a more cyclical component, we've got less in terms of information technology and healthcare. Even when you take that into account, I do think, like for like, you see better valuations in Canada. So, I think that really does bode well for returns for Canadian investors longer term. I don't know if that necessarily means that we'll see immediate fruits, from that difference in valuation, but longer term valuation will drive returns. And then to your point about dividends, it's really interesting when you look at how far the U.S. market's gone, everything else being equal, that's going to drive down the yield for U.S. equities. So when we look today, the dividend yield on the S&P 500 is still barely above 1%, whereas in Canada, we're looking at dividend yields for the S&P TSX Composite, the better part of 3%. So even just on dividends, you can see that it's significantly different in the favor of investors north of the 49th here.
I think about how we walked into 2025. There was enthusiasm around Trump after the election. Canada expected to have a recession this year. The loonie was in the doldrums. And so that painted sort of a bleak picture for the Canadian economy. There was also a different prospect when it comes to the federal election, which we can talk about as well. But so much changed just in the last 3 months. And now here we're sitting, the Canadian markets are outperforming US. The Canadian dollar is actually up against the US dollar. But I don't know that the economic prospects have changed all that much.
There's a lot of uncertainty facing the Canadian economy. It went into this tariff skirmish in not a terrible situation, but I think that there were some cracks emerging with respect to the U.S. or the Canadian economy. I don't think it came into this as strong as the U.S. economy, but it's not all negative either. We don't know exactly how this is going to play out. I would expect, regardless of who prevails on Monday, April 28th in the federal election, that we're going to see continued fiscal support for the economy. We just saw the costed numbers for the platforms for both the Liberals and the Conservatives, and certainly there's some differences between them, but, we will see fiscal stimulus here. And I would think that if this trade situation, puts pressure on the economy, we'll have, some support there. Amber, I think that, one thing that, we can maybe expand upon if you wish, but, we often say that the Canadian economy is certainly important for the Canadian equity market, but there's a lot of other drivers of the Canadian equity market above and beyond the Canadian economy, including like North American economic growth and trade, and even the global economy. So this Canada's equity market is rather unusual in that respect, and that there's lots of drivers to it.
Yeah, we've talked about that a lot in the past, that equity does not equal GDP when it comes to the way that the TSX is constructed. So with that in mind, and I feel like you've kind of answered the follow-up, but I'll ask it anyway. Yeah. Depending on the outcome of the federal election, it doesn't sound like it's going to materially affect how you allocate money in this country.
I don't think so, Amber. When we compare the platforms in detail that we've seen from the Liberals and Conservatives, and then we map that to the various sectors represented in the S&P TSX Composite Index, I think in many cases it's a push. It'd be very similar between the two. I think ultimately you would probably see greater fiscal deficits with the Liberal government, so maybe there's more spending, so that could drive some things. I think perhaps the wild card could be regarding the resource complex materials, and in particular energy. So I think it's pretty clear what Poilievre would like to do or intend to do should he surprise and get a majority. I think it's a little bit less clear in the scenario where the Liberals win on Monday, in terms of, ultimately their commitment and what they'll do to support the energy sector, and even more specifically egress as it relates to crude oil and natural gas. So I would think of all the sectors to watch for come next Tuesday. It would probably be the energy sector, and specifically as it relates to the oil and gas producers.
Do you think the energy sector moves higher if Polyev wins and lower if Carney wins?
Yeah, I think that's directionally right, Amber, to the extent in the aggregation of poll data that I'm looking at. The consensus really seems to be that the Liberals will get a majority in probably the 185 to 195 seat range. So to the extent that's already being discounted in the market, I guess I would maybe modify that response a little bit and say if the Liberals win, that was largely priced in, maybe a little bit of weakness. If the Conservatives were to surprisingly win, then I think you'd see, much more of a skew to a positive response in energy in that scenario.
All right. Well, we're going to talk a lot more about that because an energy stock is one of your top ideas.
Right.
But first, let's dip into the mailbag. Okay, our first question in the mailbag is about Dollarama. I'd love to hear Garey's thoughts on Dollarama. The valuation's high, but where does he see it going over the next 3 to 5 years potentially? This one coming from LaFlemme123 on X. What do you say, Garey?
Well, it's been an exceptional stock. We've been fortunate to have participated in Dollarama for a number of years. It really does anchor our consumer discretionary sector within the fund, being Franklin Clearbridge Canadian Equity Fund. You're right. I think the valuation has evolved significantly over the years as this company continues to deliver. And quite frankly, there's a dearth or a scarcity value in the Canadian market for these true growth stocks. So investors pay a premium for them. I think it's still warranted. At the margin, we've been inclined to trim our positions in Dollarama, and that would strictly be for valuation reasons. But they've performed exceptionally well in Canada. They offer, quite a compelling value proposition to the consumer. They've been very effective at growing the business. I think continuing to offer value to customers. Really keep margins at an attractive level. They've been able to reinvest in the business and continue to expand the store count in Canada. And then more recently, we've seen some of their longer term ideas in terms of growth in other regions, start to take shape as well. So when we think about, Central South America and Dollar City and the investment there, I think that's really starting to resonate in the marketplace as well. So it's a terrific business. We love the management team. We've got a lot of visibility there in terms of growth and profitability, really exactly what we like to see in a business. But the holdback for us would be the valuation. So we carry the weight at about 2%, but it's the valuation that's really, can be the rub there.
Our second question is about Parkland. This one is involved in an activist battle, and the CEO said he'll step down by the end of the year to help. That was one of the recommendations by the activists. What do you think this means for the stock? I mean, this is a full-on proxy battle between the current management and board and the largest shareholder, Simpson Oil, which is calling for a whole new slate.
Yeah, this is a very interesting situation. We are shareholders of Parkland. Institutional investors have been in dialogue with the incumbent management team and the board of directors. Time is of the essence here. The AGM is set to take place on May the 5th, so we're getting down to the short strokes here. It'll be interesting to see how this plays out. we've yet to see the very influential proxy firms weigh in on this. But that's exactly the issue. I mean, Parkland's had some real challenges in recent years, but we're still committed to this story because we think that there's a lot of value here. These assets still generate a lot of free cash flow. Yeah, there's been some disappointment, but I think some of that is cyclical as well. I think regardless of who prevails on May the 5th, I think that there's scope for improvement in terms of capital allocation, operations. And, we're hopeful that, with time, we're going to see that better recognized in the stock price. So it's been disappointing, but, we're still positive on the story here.
Do you know who you're going to side with, who you would vote with?
We've still got some discussions with some relevant parties later this week, and then we will make our decision probably on Monday or Tuesday.
I did see one analyst talk about the fact that the management team and the board are essentially taking some of the playbook. There is a strategic review already underway. They've now replaced the CEO, or signaled that they're going to replace the CEO, that in an ironic sort of way, by taking some of those measures from the activist, it might actually just be easier to stick with the current management and board because a lot of the process then is already underway versus starting from scratch with a new board.
I think that that's a good point. And, we have seen the board and management, kind of rally around some of those initiatives. I think it will really be a function, though, of some of the bigger shareholders carefully assessing the credibility of those two plans. To your point, on one hand, you've got a bird in the hand, and is that worth, two in the bush? So, we'll have to see. And, as a fairly significant shareholder, that's exactly the kind of analysis that we're just finalizing now. But it'd be premature for me in advance of the vote to indicate which way we'd be leaning.
All right, I got to try, Garey. Yeah, I would love for you to break that news here. I would love for your views on, do you think it could get sold? Can it be fixed in-house, or is the best way to kind of find another suitor for it?
Yeah, so I think that this review of strategic alternatives is really important, and that would be critical for us regardless of who prevails, that we want to see a bona fide process run with ultimate transparency on that. Whether the business would be sold en bloc, or whether it's more piecemeal, where individual assets get sold and potentially staggered over time, that remains to be seen. Based on what's been reported, there were overtures by a U.S. player for the whole business a few years ago. So I suppose that's a possibility, but perhaps some of the individual assets, whether it's the international operations or Canada plus US or the Burnaby refinery, perhaps there's better value for those to be managed discreetly in terms of surfacing value. At the same time, of course, the upshot of that process might be that, the status quo and continuing to run the business is the best course of action.
And you think that'd be fine? Sometimes when companies say that, the stock can plunge.
Yeah, I guess until we see what's out there, I really don't know how to handicap that. As I said earlier, the reason we're still attracted to this story is that we think this business is worth considerably more than the current stock price in either a sales scenario or, running a go forward. So, but, we would certainly be amenable to a sale if the price is right.
Let's stick with this sector because we have another question about Couche-Tard, and Parkland is often called the baby Couche-Tard for its sort of gas stations and convenience store operations. Couche-Tard is a behemoth. It's a Canadian behemoth that operates all around the world. And their question is from Carly in Toronto. What are your expectations of Couche-Tard in 2025? I mean, this one has also languished. I mean, on a longer term perspective, it has outperformed Parkland, and I think that's why people beat up on Parkland. But Couche-Tard in its hot pursuit of 7-Eleven, that's really dented its shares. Do you own this one?
We do, and we own a significant amount of Couche-Tard, and we've owned it for more than 20 years. I think that there's, Amber, a lot of parallels actually between Dollarama, the first stock that we profiled, and Couche-Tard. It is been a terrific story in the Canadian marketplace. Growth through acquisition, literally, it started as one convenience store in Quebec, and it's now emerged as a significant global player in this space. So I think, though, what's interesting is whereas Dollarama really hasn't skipped a beat, it has been a more challenging time for Couche-Tard, and I would attribute that to a couple of things, Amber. The first of which is just from an operational point of view. I think it's been challenging for Couche-Tard, to be sure. I think that the consumer that they focus on has been a little bit more challenged. So some of the operating statistics in terms of same-store sales have been a little bit softer, particularly in the U.S. Fuel margins are notoriously volatile, but they've come off a little bit too. So it's been a tougher few quarters for Couche-Tard, but I think most importantly, we have to recognize that we've got this backdrop of the 7 & I, or the operator of 7-Eleven, and the overtures, expression of interest that Couche-Tard has made for that business. And on one hand, I think most investors, including us, would be really excited about that as an opportunity in terms of what this management team could do with that asset base. The issue, Amber, in the market is that in all likelihood, to finance that acquisition, in addition to Couche-Tard taking on a fairly significant amount of debt that ultimately would probably be manageable, but there would be a lot of equity likely that's required to finance that. So, we call that an equity overhang in the market. So to the extent people think that they might prevail and be successful in consummating a deal with 7 & I, the equity required would likely come at a pretty big discount to the prevailing stock price. So then you get into a scenario where investors are reticent to be buying, thinking that perhaps a big financing is coming their way. And it's really difficult to, quantify exactly how much that's pressured Couche-Tard, but we think it's a pretty big driver of that. It's been frustrating for us because we're big shareholders, but recently we have been adding to Couche-Tard, recognizing that issue, because at some point, the price still makes sense, and it's not a foregone conclusion that they will be successful in acquiring this Japanese-based 7 & I. That's a significant entity, and there's a lot of issues and challenges facing Couche-Tard in acquiring what's really a national champion in Japan.
So, Garey, that's a really great summary of kind of how we got to this point. The question is, it sounds like you're holding on through this period of turmoil, but if you're a new shareholder tempted to take advantage of the weakness, it could be risky. Because there is that financing overhang.
There is that financing overhang, but I guess when we think about it, probabilistically, I still think it's going to be very challenging for Couche-Tard to pull off this deal. And even if they do, we trust this management team that they would want to minimize the dilution or the amount of equity that they have to issue. There's potentially creative ways that they can do that as well. So yes, it's a risk, but I think it's a manageable risk. And look, with the stock, closer to $70 relative to where it got to before this possible acquisition surfaced more in the mid 80s, I think you're getting compensated to take on some of that risk. But potentially, Amber, you're right. There could be a downdraft, but then following that, you would be looking at a scenario where the synergy opportunities for Couche-Tard with 7-Eleven would be significant. There'd be probably a lot of concessions that would have to be made to appease the competition folks in the U.S. in the form of asset divestitures, and that's actually something that is being explored right now by Seven and I. But there would be probably a long runway of opportunity for Couche-Tard in that scenario too. So that's why I think whether you're a holder or potentially looking at it with new money, I think it would be warranted.
I don't want to belabor this, so just real quick, do you think Couche-Tard kicks the tires on Parkland and any of their assets, or do you think there's too much overlap and it just wouldn't, pass the competitive smell test?
Yeah, I haven't looked at that in detail. I think that certainly some of the Parkland assets would be non-core, wouldn't make sense for Couche-Tard to have. To the extent they're more complementary, then I think, you do get into that scenario that you just alluded to in terms of what would be the market concentration in some regions. So it could be problematic, but I haven't looked at that in detail, nor in our conversations have we heard that in any way Couche-Tard would necessarily be a front runner for that business in the event of a sale.
Okay, good perspective. We've got a couple more questions in the mailbag. Let's take a quick break.
Sure.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, our next question in the mailbag is Capital Power. This one coming from Deb in Vancouver. Would Garey buy Capital Power at these levels? And this is it's a power company that recently has traded a lot more like just a pure play AI company. And as AI stocks have got run over, so has Capital Power. Why did this stock get sucked into the AI trade?
So, Amber, I think this is a quality business, and I think management's done a lot of good things in recent years. I think it's a fine stock, but I want to be clear that we don't own that in our strategies. We just have preferences for other businesses within that utility space, and we've got very little exposure to what I would call these IPPs or these independent power producers. So just recently we saw Capital Power acquire 2 assets in the US, gas-fired power generation. That speaks to the M&A that's part of their business. So now they've got a pretty good balance between Canada and specifically Alberta in the U.S. in terms of power generation, not all of which is contracted, so they're kind of merchant in that respect, there would be some price risk, but I think certainly manageable. These businesses had a terrific run in through 2024, even early this year. And then to your point, where it looks like they're trading like AI stocks, when the news out of China regarding DeepSeek hit the market, I think it really cast a pall on a lot of these AI plays, including the power producers, where I think there is just now more of a concern as to, what really is the electricity demand pull going to be around AI, if what we're hearing in terms of the efficiencies on DeepSeek are real. So I just think it was a classic case of there was probably too much euphoria in these stocks. It's come back to reality. Capital Power just recently issued some equity at a lower price to help finance those two U.S. assets that I was referring to. So, yeah, I think it's a quality business. There's a dividend there. I think you've got good management. It just we see better opportunities elsewhere in terms of energy more broadly, or the utility space more specifically.
And we're going to find out what those are in Pro Picks. But let's squeeze in one more question in the mailbag. This one's about Constellation Software. And honestly, for tech stock, it's held up really well. And the question is from Trevor on X. It seems to me that with all this, its niche software holdings, Constellation is inherently insulated from U.S. tariffs. Would you agree with that?
Yeah, I concur with that. Like we're talking about another real Canadian champion. I think that Constellation's has been as good a stock as probably any stock for many years, kind of in that same category as Couche-Tard or Dollarama. So I agree with the question, and that I don't think there would be really any direct impact from tariffs on Couche-Tard's software business, where they tend to operate in very niche verticals. Having said that, to the extent you had a scenario where tariffs just slow down economic growth more broadly, whether that's the US, Canada, or globally, you could have a second order impact in terms of revenue growth for Constellation. Not significant, but I think it could hurt it. And then I think, ultimately, I think where the question would be coming from is, as it relates to the stock, and again, a terrific business, but it's held up very well. It now trades at a pretty high multiple. So I think that the biggest risk here is valuation risk, as opposed to something like tariffs directly impacting the top or bottom line, Amber.
So I own Constellation, and one thing I note about Constellation, since it's been a public company, back in 2006 or 7, when it went public, it has only had one down year. In 2022, even in 2008, it was up slightly. That's such a set it and forget it kind of stock. But should you not get complacent about that because of the valuation?
Well, that would be my point exactly, right? And that that can be a self-fulfilling prophecy until it stops. Like they've executed so well, and the stock has prevailed through so many different markets, that I think people really just do look to that to continue. And I think that ultimately those valuations matter, and that the more the valuation expands, I think it probably draws from long-term future returns. So that would be just our take on it. We own a small amount of Constellation. We love what they've done. We'd like to own more, but it would probably have to be at a lower price for us to do that. And then to your point about the one drawdown year, 2022, I don't have their numbers in front of me, but I would suspect that Constellation posted, solid numbers in 2022. But of course, that was a year where growth as a factor was weak in Canada, the US, and elsewhere. It was one of the few years where value outperformed growth. So, that's exactly what we might see to the extent growth were to stumble, because Constellation certainly in that category.
Yeah, they still grew their top line at around 30% that year. Okay, let's dig into pro picks now. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, your first pro pick is Canadian Natural Resources, the oil producer. And I've lost count of the number of people who recommend it. And they recommend it at 50, they recommend it at 40, and it's trading around $40 right now. I mean, no matter how much people love this stock, it seems to just keep melting lower. Why doesn't it get the love that everybody thinks it should get?
So, Amber, I'd concur that it is a consensus pick. We too hold this name in high regard. We've owned Canadian Natural Resources for many, many years. To your point about it being weak, I think that's really the opportunity here. So it is a blue chip name, definitely within the energy sector. It's Canada's largest oil and gas producer. It's got an exceptional track record. We've got 25 years of dividend growth coming from a cyclical industry. I think we've got exceptional stewardship with the management and the board, certainly led by Murray Edwards. They're very aligned in terms of their significant ownership as well. But it's ultimately at the mercy in the short term of prevailing oil and gas prices. So with the weakness that we've seen in crude oil, certainly made worse recently with the tariff situation, that has impacted the story, to be sure. So unlike some of the other real compounders or growth names that we talked about earlier that aren't as encyclical of industry, I think that's what would differentiate Canadian Natural Resources. The long-term charts, very strong, but you've got that cyclical component. So when we look at it here, oil in the low 60s, we do look at them as the low-cost producer. We think that they can generate cash flow down to a much lower oil price. So they're going to be a survivor. So then it just comes down to, what do we want to pay for that? Because that's the setup for the go forward return. So, we think with that weakness that you alluded to, that's really the setup. So, we're the kind of investor that won't necessarily be following the crowds. It's one of the stocks that I wanted to profile where we've got some of this tariff induced weakness that we think creates the opportunity. So it's been under pressure, as the whole sector has, but we're more excited about energy and have been in the last few quarters than we have for quite some time. So we are being somewhat contrarian on that. We don't know the exact path of crude oil any better than anyone else, but I think longer term, you should probably be thinking about oil closer to the $70 range in terms of a mid-cycle price where it makes sense and you're going to see sufficient supply come onto the market, and that's a price where I think demand will take that too.
Okay, so I guess that underpins why you've been excited about oil recently. What is your fair value estimate for Canadian Natural Resources then? If it's trading around 40, what do you think it's truly worth?
Yeah, I think that I've got a few different numbers in mind. So the first way I would think about fair value, Amber, is that I would just defer to the spot and futures market for crude oil. and I would take those prices and assume that that's the way prices play out. Why would I look at that? Well, I don't know if that's necessarily, the best forecasting tool, but it's at least a price that, producers could actually hedge at. So that would be one scenario that I would look at, and we'd probably be north of $50 a share in that scenario. I think getting back to my point about more mid-cycle prices, closer to $70 a barrel, and what kind of free cash flow yield the market would likely ascribe to Canadian natural resources in that scenario, I think you get probably closer to $60 a share. So, it certainly doesn't have the most torque. And, we own some names, and there are other energy names out there that if you're even somewhat constructive or bullish on oil prices, you could, get a better total return. But I think when you bring risk into the equation and we risk adjust this, we feel very comfortable in terms of the downside and the staying power of Canadian natural resources. And we're going to make a lot of money on this security. I don't think there's, we're very confident in that. Like even the starting yield right now is just a little bit less than 6%. That dividend's going to grow over time. The share count's going to be reduced, and it's going to be a bigger company.
I have to ask, I know it's not one of your pro picks, but if you are have a higher risk tolerance, can you name drop one of those torquier energy names you would go to?
Yeah, so I would, maybe stay in the crude oil space, or those producers with real leverage to crude oil. So I'll kind of talk my own book here, Amber. Some other names that we would own would be Cenovus Energy. So that stock's been, plagued by some issues, not the least of which their U.S. refining operations, but we think the risk reward is really good there. I would look at something like MEG Energy, which is really a focused producer in terms of in situ or oil sands. I think that's a terrific opportunity. Smaller cap yet would be something like Headwater Exploration. Great cost structure, very solid balance sheet, getting paid while you wait in terms of a very attractive dividend.
And to go back to what we talked to at the beginning of the show about election risk, if the polls hold true and it is a Liberal government, possibly a Liberal majority, does that dent the thesis at all, or have you already factored that in?
Maybe a little bit, Amber, and maybe a little bit maybe for the larger producers. Look, I think in the near term, when we think about egress for crude oil, I think that, with now that TMX is on stream, I think there's scope for expansion to TMX. That would, it's not a foregone conclusion that we would do that, but latter part of this decade into the next decade, there's some barrels that could move there, as well as on the Enbridge mainline and down through the U.S. I think that there's opportunities for expansion. So it's not that dire, but I think when we're thinking about some of these businesses, in particular the bigger players, the oil sands companies, where it's really dominated now by Canadian Natural Resources, Suncor, Imperial Oil, and Cenovus, that if you want to get into a more optimistic expansion scenario longer term, I think that really can only be done in the context of pipeline, either additions or expansions. But in the near term, not an issue. And some of these smaller companies that I referred to, they're nimble enough, and the numbers wouldn't move the needle sufficiently for them to have problems in terms of tapping markets, whether it's the U.S. or more globally.
All right. Well, people are really getting their money's worth because we just did a bunch of picks in one pick. So let's move on to the second one, which is CN Rail. I own
Sure.
this one as well because, everyone says it's world-class
Right.
operator and all of that. And yet here it is bouncing off the lowest level since 2021. It just continues to grind lower.
Yeah. So, Amber, I've given you three stocks deliberately to be able to compare and contrast, and I think in the case of these first two names, I think highlight what we think is a pretty good opportunity. Where again, it's a blue chip name. Most people are familiar with CN Rail. We've owned it here since the 1995 IPO. I think their track record speaks for themselves. I won't kind of belabor all the positives with respect to the business. We did see a stumble in 2024. I don't think it was their best year operationally. I think the setup is for a better 2025. But with the stock being as weak as it's been over the last year or so, I think that there's too much negativity in terms of, again, the operations and then potentially what tariffs mean to this business. So, Amber, to the extent we see a more dire tariff scenario, that does have some negative consequences for CN Rail, to be sure. Although CN Rail doesn't directly pay the tariffs, to the extent tariffs cause a decline in freight volumes and in rail traffic north-south in North America, Canada, US, or even Chinese goods coming into Canada, that second order impact definitely would be negative. And, we're not sure how long lasting that would be, but it's still, it's a defensive business. The capital, the cost structure's solid. We think at these valuations, for patient investors, the reward is really solid here, just given the magnitude of the pullback and the compression in that PE multiple. So again, I wanted to give the audience a couple of examples here of where tariff negativity we think is unduly impacted stock prices, and now's the opportunity to get into some terrific, real, global quality businesses at opportune prices.
What kind of upside do you see on CN?
Well, I guess the way we would think about that is we would probably want to normalize earnings out in 2026, 2027, maybe even beyond if there's compression due to tariffs. And then if we go back to historical multiples, 20 plus, I think that's where you easily get to 20, 30, 40% upside, maybe even shorter term in a CN Rail.
Let's end with your final pick, which is Fortis. The others are trading at lows, and you brought one to us that's trading at, is it an all-time high? It's definitely a 52-week high.
Yeah,
I think
Amber,
it's an all-time high.
Boy, you're on top of things. Yes, yesterday Fortis did reach a all-time high on an intraday basis. So Fortis is a big position for us. We have been trimming it somewhat recently. That's why I wanted to speak to this name. We went into this recent market weakness with a pretty big overweight in two defensive sectors, namely consumer staples and utilities, which is a little bit unusual for us. We have never had this kind of weight in utilities in the history of the fund. And it's not like we had a crystal ball and knew what was ultimately going to happen with these tariff policies. It was just when we look at securities on a case-by-case basis, there was a lot of good risk reward in utilities, i.e. not a lot of risk and pretty solid reward. And we've really been fortunate to have this kind of exposure to utilities because they've held up so well. Now, in the case of Fortis, again, it's an exceptional business. They've got some crown jewel regulated utilities in the U.S., both in the upper Midwest as well as Arizona. Terrific track record of dividend growth. It's held up well, and this is exactly, what we would be using to source cash for opportunities like I alluded to with a Canadian Natural Resources or a CN Rail. So fading it at the margin just, again, because the go-forward returns get less attractive as the valuation expands. So we've sold a bit, still a very big position for us. But, again, these are all high-quality businesses that we're speaking to. It just one's effectively at an all-time high and a couple of others have been quite weak, but all similar in the sense that they're, blue chip, high quality names that you could buy for the long term and do quite well and see dividend growth. But I just think at the margin, with what we've seen with tariffs, kind of paradoxically, where I think a lot of investors would be inclined to hide because, that notion of hiding out in safe names like utilities. Well, we think that sometimes you get paid to go against the grain with a trade like that.
I love it. It's something for everybody, the buy the dippers as well as those that want to stick with relative strength. Yeah. I appreciate it. Garey, thank you so much for joining me.
You're most welcome.
That was Garey Aitken joining us of Franklin Templeton. Make sure you tune in to our next episode. He's one of the most successful fund managers on Bay Street, but he's also one of the most controversial as well. I sit down an exclusive interview with Moaz Kassam of Anson Funds. If you want to get in your questions, you know how to do that. Questions at inthemoneypod.com. You can find us anywhere on social media at inthemoneypod, or of course, hit up our website and submit it there, www.inthemoneypod.com. And we'll see you on the next episode.